In today's video, I'll talk about a best of the S&P 500 portfolio. I update once a year, as well as update our tech stock portfolio, our wide moat strategy and capital light strategy, and our secular trend / sector rotation strategy. Now on this slide down here in the table, I'm showing a snippet of the stocks I picked for my best of the S&P 500 portfolio. You can see the full list on Substack on a free article I posted today. A link to the article is in the video description. Now in this portfolio, once a year I attempt to pick the best S&P 500 companies for the upcoming 12 months. And then I hold those stocks for a year. At the end of those 12 months, I redo the process, investing only in the S&P 500 companies that I think will do the best over the subsequent 12 months. Now I don't add additional funds, and I started with a lump sum investment of $2,000. Now this process is too time consuming to recalculate weekly like I do for most of my other strategies, so I stick with an annual rebalancing schedule. So this is kind of a good strategy for someone who just wants to mess with it maybe once a year and then just set it and forget it. So why did I decide to try this? I've always thought that index investing is a decent strategy for those that just want to set it and forget it and don't care that they will slightly underperform the index due to the fund's expense ratio and any other trading or friction costs. But anytime I look at an underlying index, I see that there are many companies that appear to be terrible investments. Many are in industries that are dying, or the companies have poor management that's constantly making the wrong decisions, or they have serious legal or regulatory problems. But with index investing, you're going to get the good with the bad. That's how it works. So I thought, why not try to weed out the worst companies in the S&P 500 and then just invest in the rest? And that's what I do once a year in September during the break between teaching my summer accounting and finance classes and between teaching my fall classes. So I have a break in between summer and fall, and I get kind of bored, so I wanted to experiment with this. So far, the portfolio is up 63.4% versus the S&P 500's 46.7% when we started in September of 2023. On this slide, I'm showing just a snippet of the stocks I picked. Like I said, at the bottom of the screen. There are too many to show on this video, but you can see the full list on a Substack article I wrote for free. Again, you can see the link to that article in the video descriptions. So hi, Professor X here, back on the video track. In this week's video, I'm going to focus on the simple tech stock portfolio that my accounting students and I started in April 2024, as outlined in red. I'll also talk about 3 newer strategies I'm investing in: capital light companies and wide moat stocks, which is a simple way to ensure that you're investing only in companies with the strongest competitive advantages. And we also talk about a secular trend and sector rotation strategy I'm trying for fun. Now, if you're interested in the dividend growth portfolio on the far left, I started a completely free Substack featuring that portfolio to see if I like the Substack platform. You can sign up and see which dividend growth stocks we're buying in real time on Mondays. Now, in that same Substack, I've been posting the capital light and wide moat stocks that we've been buying each week. But let's get back to our tech stock portfolio outlined in red on this slide. It's a real-world investment portfolio where I make additional investments on the first trading day of each week. It's by far our most volatile portfolio because it's not diversified, since it only invests in one sector, and tech stocks by their very nature tend to be very volatile. Also, it's our newest full portfolio, so its performance will fluctuate up and down more so than our other portfolios, which have longer track records. Our tech stock portfolio so far has an annualized return of 29.54%. Now in next week's video, assuming I have time to make it, because fall quarter is starting up and things are getting busy, we'll talk in depth about our dividend stock portfolios that my accounting students and I started back in 2022 and 2023, as outlined in yellow. Like our tech stock portfolio, they are real-world investment portfolios where I make additional investments on the first trading day of each week. So in effect, they are accumulation portfolios, mimicking someone in their working years who is consistently adding to their investment portfolios. And as a reminder, the portfolios on the right in the light blue outline are portfolios that I started in 2003 when I was in college. These portfolios are more buy and hold portfolios with infrequent trading, so their lack of action might make for boring videos. If you prefer strategies with infrequent trading, you can check them out on a new Substack I created for them. It does require a subscription, but the Substack version is less expensive than subscribing to our website, beatthestockmarket.com. I'll put the links to our 2 Substack publications in the video description. Now here's a summary of our investment strategies, their annual returns, when they were started, and where you can find them. Dividend strategies are my personal favorite since my goal is to generate passive income that is twice my annual expenses. The dividend growth stock portfolio seems to be most popular, so I put it on Substack for free as an experiment to see if the Substack platform is pretty good, and actually it is very good. I like it. So I'll probably eventually switch all the portfolios to it from our website. But you can find most of the strategies on my website now at beatthestockmarket.com. But if you can't afford a subscription, I've been trying to make weekly YouTube videos showing you the dividend stocks we've been buying one week. And then the next week's video, I usually show the tech stocks, Wide-Moat stocks, and capital light stocks, as well as our sector rotation and secular trend portfolio. Now in the green box up here, note that I've added a note that the tech stock portfolio and the capital light strategy are both newer, and therefore the average investment has been held for less than a year. This means their annualized returns can fluctuate a lot during the holding periods or until the holding periods eventually grow. So just be aware that the annual returns of these 2 newer portfolios jump around a lot, but will settle down over time as the holding period gets longer and longer. And the purple box down here is telling us that of the tech stocks portfolio, the tech stocks that are dividend paying companies, they have the best return so far in that portfolio with a 33.57% per year return. And as I mentioned in the previous slide, if you prefer investing strategies with very little trading, you can check them out on my new Substack I created for them. They include our dividend paying blue chip stock portfolio, our ETF portfolio, our 3 monthly stock screens, and it does require subscription, but the Substack version is less expensive than subscribing to our website, beatthestockmarket.com, and on that, I've put the free article to our Best of the S&P 500 portfolio, if you want to see the stocks that we chose. Now here's a weekly chart of how our weekly investments into our model portfolio of tech stocks has been growing. In this model portfolio, we make weekly investments each Monday, mimicking someone in their working years. So in effect, it's an accumulation portfolio. Each Monday we buy 10 different tech stocks, and the ratings for our tech stocks changes weekly, so the list of stocks we buy each week fluctuates. And we occasionally sell a stock when it looks overvalued or there are better opportunities in other tech stocks. Before we get into which tech stocks we bought last week, a lot of people have been asking me for my favorite books about investing. My 2 favorite books were the basis for the 3 stock screens I publish monthly on our website, which you can see on this slide. My favorite investment book is called What Works on Wall Street by Jim O'Shaughnessy, whose investment firm managed over $6.4 billion of investments when he retired. The book is the basis for 2 of the 3 stock screens I publish on my website, beatthestockmarket.com. I don't know if you can hear that, but we got coyotes howling outside and a ravine behind the house. Anyway, these stock screens are the trending value stock screen and consumer staple stock screens. I update the stock screens monthly. So what is a stock screen? It is a set of criteria used to narrow down a large list of stocks to a much smaller list of stocks in which you can invest in or do further analysis of them. The book examines various ways to tell if a stock is undervalued by examining simple metrics like the price to earnings ratio, also called the PE ratio, dividend yield, etc., as well as combinations of those simple metrics. There are a lot of tables and graphs in the book, so if you're a numbers geek like me, you'll probably like it. It also talks about the history of the stock market and the psychology of investing, which is also fascinating and super important. The other book I recommend, especially for younger investors, was written by the son of the author I just mentioned. It's called Millennial Money and is the basis for the Millennial Money stock screen that we publish monthly on our website. Of course, you can follow the book and just recreate the screen on your own. It's a much shorter book than what Works on Wall Street. I'll also be putting these stock screens on, or I should say I have put these on a separate Substack publication. And as I mentioned earlier, these stock screens, as well as our legacy stock portfolios, are now in that separate Substack. So here's a usual disclaimer. This presentation is for informational purposes only. It's not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own due diligence, which means do your own research. stock. Things can change. So let's talk about the tech stocks we bought last week. On this slide are our ratings for the top 15 tech stocks as of last Monday. I posted these rankings to our website, beatthestockmarket.com, last Monday. And then we purchased the top 10 stocks. Note that all these stocks are higher quality, meaning they must have a quality ranking of B- or better. More on what makes up our quality grade is on the next slide. Also note that the ranking system used for these tech stocks may differ from the rankings we use to rate dividend growth stocks, because some tech stocks do not pay dividends. Therefore, in this ranking, we ignore the criteria that involves dividend growth, dividend payout ratio, etc. So our highest rated tech stocks last week were Adobe, Microsoft, Accenture, ServiceNow, Nvidia, Infosys, Marvell, Salesforce, Workfor, and Manhattan. So we bought the first 10. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio. Risk is the first quality component. Tech stocks, by their very nature, tend to be riskier than most other sectors. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of the reported earnings, also called profits. And finally, the last quality component is financial health. Remember that the risk rating to compare is comparing these stocks to other stocks, not to other investments like bonds and CDs. This slide shows our best performing stocks in our tech stock portfolio. Last week, the best performers were Oracle, which had a monster day this week. It was up 25.5% for the week. Lam Research up 13.6%. Broadcom 7.5%. Taiwan Semi 6.5%. Same with KLA and Nvidia. And we also have Marvell and ASML. Now, one reason why tech stocks have been outperforming the market for several decades might be because they tend to require little capital. As a simplified example, if you want to start a software company, you just need a computer and software knowledge. On the other hand, if you want to start manufacturing cars or jets, you're going to need a lot of buildings, a lot of equipment and employees, etc. In other words, a lot of capital, which is very expensive to obtain and maintain. Now, Goldman Sachs recently published a research note that shows that companies that do not require a lot of capital have significantly outperformed companies that employ heavy capital by 544% during the period from 1990 to 2024. The research calculated capital intensity based on three simple formulas: assets divided by number of employees, assets divided by net income, and capital expenditures divided by net income. After finding this research note, I contacted the authors and discovered we might be able to get even better results, because in the study, they ranked and classified companies based on what they have as listed as 45 sectors of the ICB taxonomy, not individual companies. So not only did they look only at the sectors, they took the sector's median since 1990. So if the sector's capital intensity changed over the years, they ignored that. The authors admitted that sectors that were once capital light can become capital heavy and vice versa. And they admitted that within a given sector, one company may be capital light, while another is capital heavy. But they ignored that too. So I'm assuming they did this to save time, because otherwise they would have to look at each individual company's factors for each month or week, and then do this for each and every year in the study for each and every company, which is a lot of work when you're looking back over 30 plus years. So it seems their study could have had even better results if they dug deeper and truly found companies that were capital light, instead of just looking at sectors in general. And we can do this in real time going forward on a weekly basis, and we have been doing it. And so we've been looking for individual companies that are capital light but also high quality, and our capital light rating is based on individual companies, not on whole sectors or industries like in the study. So on this slide, I have a list of S&P 500 companies that are capital light, high quality, and appear to be undervalued using a growth methodology. These are the capital light stocks we bought on Monday for our capital light stock portfolio. Similar to our high yield stock portfolio, we're using two strategies for the portfolio. Strategy 1, in red up here, emphasizes how undervalued a company is, while strategy 2, down here in green, puts a higher emphasis on quality as a factor. Now, strategy 1 still has quality in it, but strategy 2 places a much greater emphasis on quality. So you will usually see higher quality companies in strategy 2, and you can kind of see that over here in our quality grade column. Down here for strategy 2, they are all A's or better, and up here in strategy 1, we've got a couple B's. So which strategies are performing better so far? It's very early, but strategy 1, which mainly emphasizes how undervalued the company appears to be, has been the better performer with an annualized return of 49.73%. That return will likely come way down, but so far so good. The portfolio's overall performance can be seen below. Actually, I should say the portfolio's overall performance can be seen on our third slide, which was showing it as 35.99% for the whole portfolio. So to pick the stocks in this slide, I started with a list of over 4,300 companies, and the first step was to filter out the companies that were capital intensive based on the three formulas that the authors used in the study that we mentioned on the previous slide. Now here's a strategy I started tinkering with behind the scenes in September of 2023. It's not the most diversified portfolio, so I decided to wait longer to share the results. It's a wide moat stock strategy. First of all, what's a moat? Well, Morningstar is a service that rates stocks and is famous for its moat rating, that is assigns to large companies. So what's a moat rating? A moat rating attempts to simply measure the competitive advantages of a company. If a company has no competitive advantage, then it's very easy for another company to enter the industry and take customers away from that company. They call it a moat rating because they liken it to a moat around a castle. If the moat is wide, then it's hard to storm that castle. If the moat is narrow, then it's a bit easier to attack the castle. And if there's no moat, then the castle is much easier to attack. So this strategy invests only in companies with the best competitive advantages. In other words, the companies with a wide moat. There are limitations to the moat rating, and I prefer my own quality rating system that takes much more data into consideration, including the moat rating. But the moat rating is kind of a quick shortcut way to invest only in the high quality stocks. So on the next slide, we'll see my ranking for the top 15 companies, or for the companies that we bought for our wide moat portfolio last week. But first, let's look at the strategy's performance. Like the tech stock portfolio, I've been making weekly investments in the portfolio. I originally had the strategy in a Fidelity portfolio with a few other strategies, but quickly learned that having several strategies in the same account makes it a nightmare to track their performance separately. So I sold off those holdings and have since started a Fidelity account dedicated solely to this wide moat strategy. The average investment so far has been held for less than a year and has produced a total return of 15.72%. Using Excel's rate function, that's an annual return of 48.09%. Now, the strategy doesn't result in a portfolio with as much diversification as most of our other strategies, so the portfolio's performance could fluctuate a lot, and the performance likely won't stay quite that high because stocks historically average about 10% per year. Now, Morningstar, down here at the bottom, offers an ETF that only invests in wide moat stocks, so that ETF is a natural benchmark for this strategy. Its ticker symbol is MOAT, M-O-A-T. If we'd instead invested in Moat on the same exact days that we made investments for our wide moat portfolio, we would have received a return of 8.48%, which is an annualized return of 23.23%. So 48% versus 23%, we've been basically doubling the annualized return of that portfolio. The strategy is also beating the S&P 500 by about 16 or 17 percentage points on an annualized basis. So which stocks did we buy for the wide moat portfolio? Similar to our high yield stock portfolio, we're using two strategies for this portfolio. Strategy 1, in red up here, emphasizes how undervalued a company is, while strategy 2 in green down here places a higher emphasis on quality as a factor. So you usually see higher quality companies in strategy 2. As you can see down here, over here, our quality grades for the strategy 2s are all A places except for 1A. And for strategy 1, they're still A's, but not quite as high quality. Remember, stocks in any of our strategies may appear in the list one week, but not appear in the next week, as they might barely miss a screening criteria such as earnings estimates over the next 12 months, which changes frequently. And just because the stock falls out of the ranking one week rarely means that we plan to sell the stock. Sales tend to be kind of rare. So the 5 companies we bought for Strategy 1 are Adobe, Chipotle, Infosys, Copart, and ServiceNow. For Strategy 2, we got Intercontinental Exchange, RELX Group, Chipotle, Mondelez, and Microsoft. Now, one advantage of companies with the best moats is if they pay dividends, they're more likely to increase dividends, even during an economic shock when compared to companies with no moat. Now, on this slide, Morningstar shows there are 3 categories of moats. On top, we have the companies with the wide moats, which is considered the best. This slide shows that during the 3-year COVID period, when supply chains ground to a halt and some companies saw a complete collapse in sales, about 80% of wide moat companies, those were the best competitive advantages, were able to raise their dividends despite many companies being in financial trouble. But only 18% or so cut their dividends. Now, for companies with no moat, which is the worst rating down here at the bottom, only 57% or so were able to raise their dividends, while over 30% were forced to cut their dividends. For that reason, many of our strategies only invest in companies with either a wide or narrow moat. While our quality ranking for stocks includes moats, it goes much deeper than just one metric. But if you want a simple metric for quality, moats are a good place to start. Of course, this slide only covers a 3-year COVID period. During normal periods, dividend cuts are much more rare, and on average, companies increase their dividends about 5.5% to 6% per year. Now let's talk about maybe the most fun strategy we're trying, our secular trends / sector rotation portfolio. Now, one of the major secular trends this portfolio has been investing in is the AI trend. And of all these secular trends, that's the one we've invested the most in this portfolio. So here are the stocks we have purchased for that secular trend and their performance so far based on our initial investment in each stock. The average return so far has been 7.3% over 50.5 days, which is an annualized total return of 66.43%. The S&P 500's annualized return over that same time period is 30 percentage points lower. Now, of course, they're not all doing well. You see that Eaton is down, as well as Palantir, Vertiv, and Vertiv. Now, other smaller secular trends our portfolio invests that have been outperforming include rare earth metals, gold and Bitcoin gold and Bitcoin as digital gold due to excessive U.S. debt. Although it's the gold portion that is powering our picks because our small Bitcoin investment is actually negative. It's down. So it's our 2 gold mining stocks have struck it rich, as it were, for us. And satellites have also been outperforming for us. But of course, not everything is working. Our 2 cybersecurity stocks in our cybersecurity secular trend have been underperforming, as well as our copper stock. Now, I do have strong conviction that both of these 2 trends will do well in the future. So that's it for now. In the comments, let me know if you have any questions, and also let me know what investment strategies you would like to see more of, or if there's a particular sector you would like to look at next time. Also, if you go check out the list of the best of the S&P 500 stocks, if you see any that you think I should have left out, let me know, and then maybe a year from now we'll check back at the comments and see who was right. Finally, here are the places you can reach me. YouTube, obviously, as well as our website, beatthestockmarket.com, Substack, LinkedIn, and Twitter. I hope to see you again next weekend, likely with a list of dividend stocks we have purchased on Monday. See ya.